It's free. Real estate.
We're giving you land.
It's free.
We're giving you a house.
It's real estate. Free.
It's a free house for you.
This is free real estate.
I'm not carrying these around all day. It's for your house.
2 bedrooms, no rugs. It's free.
You unlock the door to your house. We got you the real estate.
It's a 2-bedroom house. It's free. It's got a pool in the back.
It's not fake estate. It's real estate.
No fake estate. Real.
There's no financing, 0% APR, and no down payment. Wait, there is no payment. So here's something to know about free real estate. Since the real estate is free, the demand for loanable funds decreases, and this decreases the interest rate and decreases the quantity of loanable funds demanded. However, the government can counteract this by increasing their borrowing by issuing securities, and this causes a crowding out effect because the interest rates are higher. Which makes it less profitable in investment, and that decreases gross private investment.
So let me quickly discuss about crowding out effect. Suppose
It's free real estate.
Suppose
Holy, I want that. Where is it? I don't see it.
Here, let me explain something to you. This is a model of the supply and demand for real estate in the real estate market. Here's the supply, and here's the demand. If we sold it at the cost of 0, like free real estate, our supply would be much less than our demand. You see, we wouldn't be making profit from that. Although we'd sell plenty of houses, they wouldn't make any profit for us. But if we moved up here, we'd be getting a better deal, and it'd perfectly match the demand. So that's where we'd sell at the market equilibrium. And since there's always a demand for real estate and houses to live in, that cost will never be 0. You understand what I'm saying?
What?
It's free real estate.
The marginal benefit exceeds the marginal cost.
But I thought there was no cost.
Have you ever heard of the phrase, there's no free lunch? Well, the cost of getting free real estate is purchasing other real estates. That is the opportunity cost.
Wait, what? Wait, does this mean that real estate isn't free?
Okay, buddy, I know you're confused. You're really angry. You don't know what's happening right now. I know you aren't the brightest, is the thing. I understand that. There's no free real estate.
I will light you on fire! Hey, is this house any better than the last one I went to?
No.
Well, it's free. Come, take a look inside. Look at all this furniture. You're gonna have a fun time buying these, because they don't come with the house. Look at this wall.
That's a pretty nice wall.
So what do you think of the house?
It's really great. I want to buy it. How much is it?
Get out.
What?
Get out.
What?
Go. Leave.
Okay.
And stay out. Liquidity is the ease of converting something into cash, or an easily accepted medium of exchange, without losing the purchasing power. It may take several months for a willing buyer to be found and for a sale to be negotiated so that the value of the real estate can be turned into cash. Also, there's a loss of purchasing power because there's a number of fees that need to be paid to the real estate agent and other individuals to complete the sale. There's no cost, no consumption expenditures, no profits for us, but it's free real estate.
It's free real estate.
The marginal propensity to save is low, so we moved up to the production possibilities curve.
There's demand pull inflation. Demand right, supply left. The cost is so high it's free. If the equilibrium price of producing furniture in the United States drops below the world market equilibrium, the United States will export furnitures.
In this graph, the yellow line represents world market equilibrium. Blue is the United States, and its equilibrium is below the world market price, which means that it will export furniture.
If the market equilibrium price of producing furniture increases above the world market equilibrium in the United States will import furnitures.
In this example, the United States is represented by red. Its equilibrium is higher than the world market equilibrium, which means that it will import furniture.
Those are complementary goods. I'm going to take you on a tour of the real estate. It's free. This is the house. You don't ignore all the furniture, ignore him, you don't get that, that's illegal. No rugs. See the rug? See that? See the rug? You looking at the rug? You don't get that. It's free real estate. See this right here? It's land, labor, capital, and entrepreneurial ability.
You may be asking, what does this have to do with real estate?
What does this have to do with real estate?
No.
It has nothing to do with it. It's free real estate. Free real estate. Unemployment goes down. Inflation goes up.
Since we're not making any profits, we're going to have to fire all those people. Unemployment goes up, inflation goes down. As more people get their free real estate, the demand for condos goes down.
Those are substitute goods.
Free real estate hurts people. It destroys the economy. It makes it go into a recession. Buyers out there, don't get free real estate. Sellers, don't do it. This PSA was paid for by the Fed.
When you buy a house, you're going to want to get a mortgage for it. This is a loan for buying houses. The economic reason for getting a loan is that 1, it allows you to purchase a house in which you would not have been able to pay for up front, and 2, even if you have the money, the opportunity cost of paying the money all at once usually exceeds the benefit of holding it under a mortgage. This is because the money that could have been saved for a longer period of time could have generated greater returns than the interest rate on the loan. For example, the average APR for a 30-year fixed-rate mortgage is 4.75%, whereas the average rate of growth in the stock market is 7%. By holding on to the money for a longer period, in which this happens for a mortgage, you are able to invest it and end up better off than you would have been if you were paid for the house up front. This is the opportunity cost of paying the money up front. Because you do not have the money if you pay up front, you are unable to invest it. And although you don't have to pay a premium, you won't end up generating the returns that come from investing the money in the first place. Important mortgage terms include APR, short for annual percentage rate, which is the annual cost of credit. Mortgages can be either fixed rate, meaning there will be no change in interest rate, or variable rate, meaning the interest rate is free to fluctuate with the market. Mortgage rates follow the federal funds rate, which is adjusted by the Federal Reserve in order to stabilize the economy. The federal funds rate is the premium of which banks loan money to each other overnight. The actions that the Federal Reserve takes to change the federal funds rate are known as monetary policy. When applying for a mortgage, lenders will look at your credit, assets, and job to determine what rate they will charge you for the money, and whether or not you will actually are a good candidate for the mortgage in the first place. Candidates with a higher risk are given higher rates to counteract the high chance that they will default on their mortgage. These mortgages are known as subprime mortgages. In order to minimize the risk of these subprime mortgages ending in defaults, lenders began selling the mortgages to investors, who would from then on be the recipients of the preceding payments. With this strategy, lenders began giving out more and more mortgages to borrowers, even if they had a very high risk. Because banks no longer were the ones who were receiving the mortgage payments, higher risks did not necessarily bother them because other people were the ones taking those risks now. When a multitude of borrowers defaulted on their mortgages, the Great Recession of 2008 occurred.